Hello, fellow traders. This is Dave the Trader back to talk about the basics of the risk profile chart. What you're looking at right here is the risk profile chart of an Amazon Iron Condor, consisting of a long 1660 put, a short 1700 put, a short 1850 call, and a long 1885 call. What you can see from this chart, when you look at the magenta line, this magenta line right here represents the value of this trade today. So the value of the trade, if I unwound it today, if I closed it, would be $419 if the stock price is $17.75. The stock price actually is not $17.75, it's $17.51.60. The last one, which is right here. And the value at that point is $355. So the value of this trade currently is $355, give or take. The blue line is the value of this trade at expiration. So if the price continued to stay, unlikely enough, at $17.51.60 all through to expiration, on expiration day, this trade would be valued at $1,395. The $357.70, that value appears both here and here. The value at expiration appears right here. And it's color-coded to match the line. We'll go into more detail about what all of these lines mean and how to manipulate them so that you get some insights into your trades. But right now, just understand what a risk graph is showing you. That is, the price of the underlying is across the x-axis, across the horizontal axis. The value of the trade is along the y-axis, or the vertical axis over here. Down here we have your position, which we currently have. These are the prices at which these options were bought or sold. Here's the quantity and the side that you're on, long or short the position. If it's long, this will be a positive number. If it's short, this will be a negative number. This lets you know what type of thing you're looking at. There's no stock in this position, but there are 4 different types of options. The types of options are over here, the puts and the calls. The yield is not important unless you get bonds or something in there. Vol is volatility, the volatility of these options. And this is their deltas. The delta of the entire position is the sum of all these deltas. And of course, this is the buying power effect. So right now, $4,000 is being held by the brokerage in your account in order to maintain this trade. Now, the way you manipulate this chart, if it's not giving you the view exactly that you want, you can click on it and pan to the left, click on it, pan to the right. If you move up and down, it doesn't go anywhere. If you click on the stock prices, you can scroll outward like this to stretch these out. Whoops. Now I gotta warn you, it is the case that when you're panning this chart, ThinkorSwim is a little buggy, and it has a tendency to jerk around in ways that are difficult to predict. I'm not exactly sure why, but like that, it flashes. So just so you know, it's not always very smooth. You can collapse the prices together to get more price points on either side showing. You can manipulate the y-axis. Right now, it's floating, which means it's setting the default y-axis. Click here. You can click on fixed y-scale. Once you click on it fixed, it's not floating. And when you click on it, if it's above the 0 line, you can pull it higher and higher, like this. or collapse it back down. Okay. Generally, I like to keep the character sort of the trade in the window and nothing else. So that's my own definition of character. But so I drag it over about there, and then I expand it out to about there. So I get a little bit on each side, but all of the action is really happening right in here. Now let's take a tour. Take a tour of different positions that I have on this my paper trading account. This is my Amazon Amazon Iron Condor, which is doing nicely right now. I'm very pleased with this trade. It's making money. Let's look at this one. This is on Deutsche Bank. Deutsche Bank, this is just a naked put position. So I've sold 15 puts. There are 7 puts, and Deutsche Bank is currently trading at $7.22. So they're safe for now and making money. Here's PG&E, a utility company out in California. You might have heard about it. I currently have a strangle on PG&E, which is currently losing money, but its theta decay is very positive, so we're making money every day on this trade, as long as the price doesn't move too much. But it has raised up on me a little bit since I put this trade on. Now we can take a look at Oracle, and you see I currently do not have any positions on an Oracle. So let's put one on. I want to show you the risk graph of a single share of 100 shares of stock looks like. So if I were to go long Oracle, if I click on this, the ask price, then I'm now creating, since I'm adding simulated trades. So the simulated trade here is 100 shares of Oracle at $54.90. Now, if I'm going to go back to the risk profile and take a look at the risk profile of those shares of stock, it looks like this. This is very simple to interpret. If I bought Oracle at $54.90 a share, and it went to zero, I will have lost $5,490. I guess I can't quite get to the 0 point there. Basically all of my money. On the other hand, if it goes up to $80 per share, 80, moving around, 80.05, how good enough. Then I will have made $2,515. And of course, my break-even point is when the stock is at $54.90. Now, that's stock. Boring. Okay, so now let's take a look at what it would look like if we sold a covered call against this Oracle position. Go to Add Simulated Trades. We'll add a covered call, say 42 days to expiration, so we get something for it. And let's do delta of, let's say, about 25%, 27 delta, and sell that call against it. We're going to get between 61 and 67 cents. Let's say we ask for and get 64 cents per share for that. 54.90 was the ask. The bid is 54.62. The last is 54.83. We probably get the last, 54.83. There we go. So that's roughly a fair value for our trade. We come back here and look at this. We're going to need to focus on right where the action is here. Stretch out these prices, like so. There. So the current value is going to be, at expiration, it's going to be valued, if the stock price does not move at all, and it's 54.83, then we will make $64 on this trade, which is exactly what we received for the call. So this makes total sense. As of today, the value is, well, I can't put this line precisely, but it's basically zero. It's only over time, or if the price changes, the price of the underlying, if it changes, then we'll make or lose money. So this is the effect of your covered call. It trades away the benefits of the upside in return for this profit right here that's going to be in your pocket. So those are the basics of our risk profile. You should understand how to view them, change them, zoom them in and out, and really what it is you're looking at by looking at this risk graph. Next, we're going to talk about these little yellow lines here. You might have noticed them going up and down. There are 3 of them in this. And there's also some percentages here. We'll talk about exactly what those are. Those are called price slices. And in the next video, we'll talk about those.